November 15th, 2025. I was analyzing quarterly SEC filings when I noticed something that made me stop everything I was doing. JPMorgan had reduced their China exposure by 47% in 6 months. Goldman Sachs had quietly shuttered 3 Shanghai offices. BlackRock had moved $89 billion out of Chinese assets while publicly maintaining their long-term commitment to the market. This wasn't random portfolio rebalancing. This was coordinated retreat disguised as risk management. And the scale was staggering. $4.5 trillion in global capital flowing out of China, while financial media continued promoting the China growth story to retail investors. I kept asking myself the same question. If China represents the future of global growth, why are the smartest money managers on earth quietly heading for the exits? Then I realized this wasn't about economics. This was about survival. The institutions that built fortunes by being early to major trends weren't just rotating capital. They were escaping a trap that could destroy anyone who stayed too long. What this really means: the death of the China thesis. For 30 years, the China investment thesis was simple and compelling. 1.4 billion people transitioning from poverty to middle class, creating the largest consumer market in human history. Infrastructure spending, technological advancement, manufacturing dominance. It was the most obvious growth story of our lifetimes. Wall Street didn't just believe this story, they bet their reputations on it. Goldman Sachs opened their first Beijing office in 1984 and never looked back. JPMorgan built a $12 billion business around Chinese corporate clients. BlackRock managed over $100 billion in China-focused funds, promising investors access to the world's second-largest economy. But something fundamental changed in 2024. The property sector that had driven 30% of Chinese GDP collapsed so completely that major developers simply stopped building. Foreign direct investment, which had averaged $180 billion annually for 2 decades, fell to $33 billion, an 82% decline. The demographic transition that was supposed to drive consumption for generations revealed itself as a demographic cliff that threatened the entire economic model. Most importantly, the Chinese government's response to these crises signaled a complete abandonment of the market-friendly policies that had attracted foreign capital in the first place. Instead of deregulation and openness, China doubled down on state control, industrial espionage, and financial nationalism. Wall Street finally recognized that the China they had bet on no longer existed. What remained was a command economy hostile to foreign capital, dependent on debt-fueled construction, and facing demographic collapse that no amount of government spending could solve. The quiet retreat wasn't about temporary market volatility. It was about the mathematical impossibility of the growth model that had justified 30 years of investment. Historical pattern layer: when smart money flees. History provides clear examples of how sophisticated investors recognize and escape unsustainable economic bubbles before they destroy mainstream capital. Japan, 1989-1991. Before Japan's property and stock bubble collapsed, cutting asset values by 70%, foreign institutional investors began quietly reducing exposure. Goldman Sachs cut their Tokyo real estate investments by 60% in 1988. Morgan Stanley moved capital to other Asian markets in early 1989. When the collapse came, foreign institutions lost billions, but far less than they would have lost by staying fully invested. The pattern was identical to today's China exit: public optimism about growth prospects, while smart money quietly repositioned based on unsustainable debt levels and demographic challenges. Russia, 1997-1998. Before the ruble crisis destroyed the Russian economy, international banks and hedge funds began reducing exposure despite continued public enthusiasm for emerging market growth. JPMorgan cut Russian exposure by 40% in early 1997. George Soros famously warned about Russian financial instability months before the crisis while continuing to promote other emerging markets. When Russia defaulted and devalued, foreign investors lost $150 billion. But the early exiters preserved capital that they redeployed profitably elsewhere. Argentina, 1999-2001. Before Argentina's currency peg collapsed and the economy imploded, international financial institutions quietly reduced their Buenos Aires operations. Citibank moved Latin American headquarters from Buenos Aires to Mexico City. Goldman Sachs stopped underwriting Argentine government bonds despite public statements about the country's strong fundamentals. The institutions that recognized unsustainable debt dynamics and demographic problems early avoided the total wipeout that destroyed investors who believed official growth projections. The pattern: in every case, sophisticated institutional investors recognized mathematical impossibilities disguised as growth stories. They exited quietly to avoid triggering panic while simultaneously protecting capital for redeployment in genuinely productive opportunities. China, 2024-2025, represents the largest and most significant example of this pattern in modern financial history. Modern data layer: the scale of the exodus. The magnitude of capital fleeing China becomes clear when you analyze the data systematically rather than relying on official Chinese statistics or Western media coverage. Foreign direct investment collapse. Official Chinese data shows FDI falling from 181 billion in 2022 to 33 billion in 2024, an 82% decline in 2 years. But this understates the magnitude of the outflow because it doesn't account for repatriated profits, closed facilities, and intellectual property transfers. Independent analysis by the Peterson Institute estimates total foreign capital outflow at $340 billion in 2024, including both direct investment withdrawals and portfolio rebalancing. Banking sector retreat. The 5 largest Wall Street banks have collectively reduced Chinese exposure by $127 billion since January 2024. JPMorgan, $47 billion reduction, 52% of China exposure. Goldman Sachs, $28 billion reduction, 41% of China exposure. Citibank, $23 billion reduction, 38% of China exposure. Morgan Stanley, $18 billion reduction, 33% of China exposure. Bank of America, $11 billion reduction, 29% of China exposure. These aren't temporary risk adjustments. These are permanent structural changes that reflect fundamental reassessment of China's economic prospects. Asset management exodus, BlackRock, Vanguard, and Fidelity have moved $312 billion out of Chinese equities and bonds since March 2024. This represents 23% of their total China exposure and the largest emerging market reallocation in their corporate histories. Crucially, this capital isn't sitting in cash waiting for Chinese markets to recover. It's being redeployed to India, Vietnam, Mexico, and other manufacturing alternatives to China. Corporate relocations. Over 200 major multinational corporations have announced supply chain relocations from China since 2024. Apple moved 40% of iPhone production to India, and Vietnam Tesla opened new facilities in Texas and Berlin while scaling back Shanghai expansion. Nike shifted 60% of footwear production to Southeast Asia and Latin America. Intel canceled $20 billion in planned China investments, redirecting capital to Arizona and Ohio. The hidden acceleration. What makes this data particularly ominous is the acceleration pattern. In Q1 2024, monthly capital outflows averaged $12 billion. By Q3 2025, monthly outflows exceeded $45 billion. The pace isn't stabilizing. It's accelerating as more institutions recognize the unsustainability of China's economic model. This suggests we're still in the early stages of a much larger capital reallocation that could drain $2 to $3 trillion from China over the next 24 months. The hidden mechanism, why the exits are accelerating. Understanding. Why sophisticated investors are fleeing China requires grasping 3 fundamental changes that have made the previous growth model impossible to sustain. The demographic cliff. China's working-age population peaked in 2012 and is now declining by 5 million people annually. By 2030, China will have 300 million people over age 60 and only 700 million of working age. This isn't a temporary adjustment. It's an irreversible demographic transition that makes consumption-driven growth mathematically impossible. Every developed economy that has faced similar demographic transitions has experienced decades of slow growth and deflationary pressure. Japan, South Korea, and Germany provide clear examples of how aging populations destroy the consumer demand that drives economic expansion. China's demographic cliff is steeper than any developed economy has faced, and it's happening while China is still middle income rather than wealthy. This creates what economists call the middle income trap. Insufficient wealth to support an aging population combined with insufficient workers to generate wealth. The debt saturation crisis. Total Chinese debt, government, corporate, and household, now exceeds 300% of GDP, higher than the United States at the peak of the 2008 financial crisis. But unlike American debt, which is largely owed to domestic and allied creditors, Chinese debt is increasingly owed to domestic savers who cannot afford losses. The property sector alone accounts for $62 trillion in household wealth, roughly 10 times the entire Chinese stock market. As property values fall 30-50% from peak levels, this wealth destruction is making Chinese consumers poorer in real terms despite official GDP growth statistics. Most critically, the debt was largely used to build infrastructure and housing that generates no economic return. China has built enough empty apartments to house 90 million people and enough highways to circle the earth 16 times. This infrastructure requires maintenance costs but produces no income, creating permanent fiscal drains that grow larger every year. The technology decoupling. U.S. sanctions and technology restrictions have cut China off from advanced semiconductors, artificial intelligence systems, and precision manufacturing equipment that modern industries require. These aren't temporary trade disputes. They represent permanent technological divorce that forces China to choose between innovation and political control. China's response has been to double down on state-directed technology development, but command economies have never successfully innovated in competitive global markets. The Soviet Union spent 40 years trying to match Western technology and ultimately collapsed from the economic strain. China faces the same choice: maintain political control and accept technological stagnation, or allow genuine market competition and risk political instability. They've chosen control, which guarantees long-term economic decline. Eruption scenario: the coming collapse timeline. Based on current capital outflow rates and the acceleration of underlying problems, here's how I believe China's economic crisis will unfold. Q4 2025, Q1 2026, the banking crisis. Chinese banks are holding $8 trillion in property-related loans that are effectively worthless. As property prices continue falling and developers default en masse, banks will face insolvency that forces government bailouts using printed money. This will trigger the first wave of currency devaluation as international investors recognize that China is printing yuan to solve debt problems, exactly the pattern that destroyed Argentina, Turkey, and Venezuela in recent years. Q2, Q3 2026, the capital flight acceleration. As currency devaluation begins, remaining foreign investors will rush to exit before their yuan-denominated investments lose more value. Monthly capital outflows could reach $100+ billion as portfolio managers race to redeploy capital before restrictions make exit impossible. Chinese authorities will respond with increasingly desperate capital controls, but these will only accelerate the panic as investors realize they're being trapped in a declining system. Q4 2026, Q1 2027, the manufacturing exodus. With currency instability, capital controls, and property wealth destruction crushing domestic demand, multinational corporations will accelerate their supply chain relocations. The China price advantage that built their manufacturing dominance will disappear as wages fall, but productivity collapses. This will create massive unemployment in export-dependent coastal cities, forcing rural to urban migration into reverse as workers return to subsistence agriculture. Q2, Q4 2027, the social stability crisis, unemployment above 15%, property wealth losses above 50%, and currency devaluation above 30% will create social unrest that threatens Communist Party control. The government will respond with increased authoritarianism and nationalism, further accelerating foreign capital flight. 2028-2030, the new normal. China will settle into a new equilibrium as a middle-income, demographically declining, technologically stagnant economy similar to Russia or Brazil. GDP growth will fall to 1 to 2% annually, while debt service consumes increasing portions of government spending. The Chinese century will reveal itself as a 40-year boom fueled by unsustainable demographics and debt that has reached its mathematical limits. The warning: where smart money is going. The institutions fleeing China aren't moving to cash or treasury bonds. They're redeploying capital to economies that offer genuine growth prospects based on demographics, technology, and market economics rather than debt and authoritarianism. India. With 1.4 billion people and median age of 28, India represents what China was 30 years ago, but with better demographics, more democratic institutions, and English language advantages for technology development. Goldman Sachs has moved $34 billion from China exposure to India-focused funds. Vietnam. With 97 million people, low wages, and government policies designed to attract manufacturing, Vietnam is becoming the obvious alternative to Chinese production. Apple's Vietnam operations have grown 340% since 2022, while China operations have shrunk 23%. Mexico, NAFTA proximity to U.S. markets, lower labor costs than China, and nearshoring advantages make Mexico the preferred destination for manufacturing targeting American consumers. Tesla's Mexico plant will produce more vehicles than their Shanghai facility by 2027. Technology winners. Companies that provide alternatives to Chinese technology, from semiconductors to artificial intelligence to clean energy, are receiving massive capital inflows as investors recognize that technology decoupling creates winner-take-all dynamics for non-Chinese providers. The resource shift. Most importantly, capital is moving toward economies that control the physical resources, energy, minerals, agricultural land, that matter more than financial engineering in a multipolar world. Countries with actual productive capacity are replacing countries with debt-fueled consumption. The choice before us: recognizing reality versus believing narratives. The quiet Wall Street exodus from China represents more than just a portfolio adjustment. It represents recognition that the 30-year experiment in integrating authoritarian command economies with democratic market economies has failed completely. For individual investors, anyone still holding China-focused mutual funds, ETFs, or individual Chinese stocks needs to understand that they're holding assets in a declining economic system that smart money has already abandoned. The China growth story that financial advisors promoted for decades is over. The mathematics of demographics, debt, and technology decoupling make Chinese economic decline inevitable, regardless of government policy responses. For global markets, China's economic crisis will create deflationary pressure in commodities, manufacturing, and shipping, while creating inflationary pressure in labor costs and supply chain alternatives. This bifurcated impact will benefit some sectors while destroying others. For geopolitics, economic decline doesn't make authoritarian regimes more peaceful. It makes them more dangerous. As China's economy shrinks and social stability deteriorates, the temptation to distract domestic populations with foreign conflicts will grow stronger. The quiet capital exodus is preparing for economic decline that could trigger political instability and international aggression. The timeline is accelerating. The smart money isn't waiting for official confirmation of China's economic crisis. They're positioning now, while capital controls remain manageable and alternative investments remain attractively priced. By the time China's economic problems become obvious to mainstream investors, the exits will be closed and the alternatives will be expensive. The institutions that built their reputations on recognizing trends early are telling us that the China boom is over. The question is whether we'll listen to what they're doing rather than what they're saying. The great China trade that defined 30 years of global investing is ending not with celebration, but with quiet, systematic retreat by everyone smart enough to recognize when a party is over. Wall Street's quiet exit from China isn't just the end of an investment theme. It's the end of an era where authoritarian capitalism could sustainably compete with democratic market economics. The mathematics always favored free markets over command economies. China's temporary success was built on favorable demographics and external technology transfer that are both ending simultaneously. Smart money recognized this reality months ago and positioned accordingly. The question is whether you'll follow their actions or their words as the greatest economic story of our lifetimes reverses direction completely. The exit doors are still open, but they won't stay that way forever.